So, you want to start investing. Today I want to share with you a question that's asked a lot. Is it possible to start investing with just $100? The simple answer is yes. In this video, I'm going to show you how. Investing can seem daunting, especially when you're just starting out. But with a little bit of knowledge and a small amount of cash, you can start building your wealth and securing your financial future. So if you're ready to learn how to put your money to work, sit tight. Let's dive into the world of investing. Now, you've probably heard of the saying, make your money work for you. Well, that's exactly what investing is all about. Investing is important because it provides a way for you to grow your wealth over time and secure your financial future. Think about it. If you just keep your money in a savings account, the interest rates are usually very low, and over time the purchasing power of your money can actually decrease due to inflation. But if you invest your money into different types of assets such as stocks, bonds, mutual funds, or real estate, you have the potential to earn a much higher return on your investment, higher than the rate of inflation in most cases. By investing in assets that can potentially appreciate in value, you can offset inflation and grow your wealth over time. This can help you achieve long-term financial goals such as saving for retirement, buying a home, or funding a child's education. However, by starting to invest early and consistently, you can take advantage of compounding interest and potentially earn even more over time. Investing is an important tool for securing your financial future and achieving your long-term financial goals. So, if you haven't started investing yet, there's no better time than now to get started. Understanding the basics of investing. What is investing? This is a hard question to answer because it's such a broad term, but investing, at its core, is all about putting your money into assets that have the potential to increase in value over time. When you invest, you're essentially buying a piece of ownership in a company or an asset with the hope that its value will increase. For example, if you invest in a company's stock, you become a part owner of that company, and as the company grows and becomes more profitable, the value of your investment may increase. The way investing works is through the principle of supply and demand. As more people buy into a particular asset, its demand increases, and so does its price. On the other hand, if fewer people want to buy that asset, its demand decreases, and its price follows. Investing also involves managing risk. There's always the potential for an investment to lose value, so it's important to diversify your investments and not put all your eggs in one basket. By investing in a variety of assets, you can reduce your overall risk and potentially increase your returns. What is the difference between stocks, bonds, and mutual funds? When it comes to investing, there are several types of assets you can invest in. While each type of asset has its own unique characteristics, they all share the same common goal of helping you grow your wealth over time. Let's start with stocks. When you buy a stock, you're essentially buying a share of ownership in a company. This means that if the company does well and its value increases, the value of your stock may also increase. However, stocks can be volatile and their value can fluctuate greatly based on factors such as the company's financial performance, industry trends, and overall market conditions. Bonds, on the other hand, are a type of debt security. When you buy a bond, you're essentially loaning money to a company or government entity. In return, you receive regular interest payments, and when the bond matures, you receive your initial investment back. Bonds are generally considered to be less risky than stocks, but they also tend to offer lower potential returns. Finally, there are mutual funds. A mutual fund is a type of investment vehicle that pools money from multiple investors and uses that money to buy a diversified portfolio of stocks, bonds, or other assets. This can help to reduce the risk and offer potential for higher returns than investing in a single stock or bond. Mutual funds are managed by professionals who make investment decisions on behalf of the investors in the fund. Overall, while each type of investment has its own unique characteristics, it's important to remember that investing involves managing risk and diversifying your investments to maximize your returns. The risk versus reward of investing. While investing can potentially help you grow your wealth over time, it's important to remember that all investments come with some level of risk. The potential risks of investing include the possibility of losing some or all of your initial investment, as well as fluctuations in the value of your investments. The risk of losing money is especially high when investing in individual stocks, as the value of a stock can fluctuate greatly based on a variety of factors such as company performance, industry trends, and overall market conditions. However, Investing in a diversified portfolio can help to reduce your risk and potentially increase your returns over the long term. On the other hand, the potential rewards of investing can be significant. If you make smart investment decisions and stay committed to your long-term goals, you can potentially grow your wealth over time and achieve financial freedom. In addition, investing can provide a source of passive income through dividends or interest payments, which can help to supplement your other sources of income. It's important to remember that investing is a long-term game, and that success requires patience, discipline, and a solid understanding of investment principles. By managing your risk and staying committed to your goals, you can potentially reap the rewards of investing and secure your financial future. Choosing the right investment for you. As I've stated previously, there are many investment opportunities available, but will they work for you? Some investment options that are well suited for those with a small budget are index funds, fractional funds, and certificate of deposit. What are all of these things though? Let's start with index funds. Index funds are a type of mutual fund or exchange traded fund, ETF, that tracks a specific financial market index such as the S&P 500 or the Dow Jones Industrial Average. These funds seek to replicate the performance of the underlying index by investing in the same stocks or securities in the same proportion as the index. Index funds are designed to provide investors with broad market exposure at a low cost, making them an attractive investment option for those seeking long-term growth. Because they are passively managed, index funds typically have lower fees and expenses than actively managed funds, which can improve an investor's overall returns over time. Additionally, index funds provide diversification by investing in a wide range of companies within a given index, reducing the risks associated with investing in individual stocks. Now, fractional shares. Fractional shares represent a portion of a whole share of a stock or other security. They allow investors to own a fraction of a share instead of having to buy a whole share. Fractional shares can be purchased through some brokers or investment platforms, and allow investors to diversify their portfolio with smaller amounts of money, as they do not need to buy a full share. Now, last but not least, certificate of deposit, or CD. A certificate of deposit is a financial product that allows an individual to deposit a fixed amount of money with a bank or financial institution for a set period of time, typically ranging from a few months to several years. In exchange for the deposit, the bank pays a fixed interest rate, which is usually higher than the interest rate on traditional savings account. Once the CD matures, the individual can withdraw their initial deposit plus any earned interest. However, if the individual withdraws the funds before the CD reaches maturity, they may be subject to a penalty. CDs are generally considered to be safe investments as they are insured by government institutions globally. While these are all great investments, they each have pros and cons which are necessary to consider. So what are these pros and cons? Let's find out, starting with index funds. The pros are, they offer a low-cost way to invest in a diversified portfolio of stocks or bonds, they provide broad market exposure, and they can provide long-term growth potential. But the cons must also be considered, which are, the returns from index funds may not be as high as individual stock investments, there is limited control over the specific stocks included in the fund, and there is still some risk involved, particularly in market downturns. Now, fractional shares. The pros are, you're able to invest in companies that have high stock prices without sacrificing a large sum of money. They enable you to invest in a number of companies or funds, or in other words, diversify your portfolio, and it allows you to invest in companies that you believe in. The cons are, you may have limited access to the stock's voting rights, you have lower liquidity than full shares, and some fractional share providers may charge fees. Now on to certificate of deposit. The pros are, they offer very low risk, they provide a fixed rate of return so you know your return on investment, and governing bodies ensure these investments. The cons are, they typically have lower returns than other investment options, your funds are locked up for a set period of time, and if you choose to withdraw your funds before the deposit has matured, you may be subject to early withdrawal penalties. How diversification helps reduce risk. Diversification is important when investing because it helps to spread out your risk and reduce the potential impact of any one investment's performance on your overall portfolio. When you diversify your portfolio, you invest in a variety of different assets rather than putting all your money into just one investment. By diversifying your portfolio, you're able to reduce your overall risk because if one investment does poorly, the other investments in your portfolio may perform well and offset those losses. This helps to protect your portfolio from significant losses due to the poor performance of a single asset or market sector. Furthermore, Diversification allows you to take advantage of the different investment opportunities available in the market. Different types of investments perform better in different economic conditions. By diversifying, you can take advantage of the strengths of different asset classes and also be protected from the weaknesses of others. Overall, diversification is an essential part of a successful investment strategy. It helps to protect your portfolio against volatility and minimize your risk while potentially maximizing your returns. So when building your investment portfolio, it's important to aim for a mix of different assets, classes, and investment options to ensure proper diversification. So, which option is the best for your first $100 investment? Personally, I would do fractional shares of indexes or ETFs, as these portray a broad range of companies which tend to do well. This strategy also allows for diversification with a small amount of money, so your risk is reduced substantially. Most indexes and ETFs also pay dividends, which can be used to increase your portfolio's value even more by reinvesting them into the same index or ETF, or by putting them into other assets to diversify your portfolio even further. Now, on to the fun stuff. Setting up your first investment account. I'm only going to talk about accounts that allow you to invest in stocks, EFTs, and indexes, as this is what I would personally do if I were investing my first $100. There are many different brokers you can use to get your foot in the door, but in Australia, Stake is a great option for investing in American and Australian stocks, indexes, and EFTs. CommSec Pocket is also a great option if you want to invest in the ASX, but you're not too sure what to invest in. So, what do you need when setting up your account? Unfortunately, most of these accounts require you to be 18 years old, but you can ask your parents to open a custodial account in your name, which will allow you to invest. I've left some links in the description regarding custodial accounts. When setting up an investment account with Stake in Australia, there are several requirements that you'll need to fulfill. These are: be 18 years or older, have a valid address in Australia, be an Australian resident, citizen, or have a valid visa, and have any Australian government ID, like a license or passport, or a bank account in your name. In some circumstances, Stake may also ask you to provide extra documentation. These are a photo of your government issued ID, a photo of you holding that ID, and a copy of your bank statement or utility bill, showing your current address. Every broker will have some sort of fees. Stake and CommSec Pocket are much the same. Stake has a minimum deposit requirement of $50 Australian. They have minimal fees, but they are as follows: a trade fee of $3 under $30,000 and 0.01% thereafter, a foreign exchange fee of $2, a speed fee if you would like to deposit funds instantly, which is $2, and some payment methods also have a fee. But I believe that Stake has very competitive fees and they are worth the price. CommSec Pocket is also another great option, but they only offer 7 ETFs. It's a good option as you have the facilities to invest in the Australian stock market with a small amount of money, where usually you need to buy in with $500. They only charge a fee of $2 on every investment under $1,000 and a 0.2% fee if it's over $1,000. Now, investing your $100. It's what you've all been waiting for. Investing. If you're going to use Stake or CommSec, I would recommend having a look through their websites and downloading the apps, which I've linked in the description. They are both great platforms for beginners and experienced investors alike. I primarily use Stake, so I'll quickly run through how to purchase an asset and the different ways to buy on Stake. First is funding your account. All you need to do in order to fund your account is sign up, then choose one of the many payment options, and deposit a minimum of $50 Australian. If you do end up using Stake, make sure to use my referral code on the screen, which will give you a free stock if you sign up for a Wall Street account. After your account is funded, use the search feature to search for any company or ETF you would like to invest in, then press buy. Now, if you press on the type of order as depicted on screen, you will notice there are 3 order types. These are market order, which is an immediate request to buy or sell at the best available price in the market. It guarantees quick execution, but not the exact execution price. Market orders are very simple. All you have to do when buying is input the amount you are willing to spend, and Stake does the rest for you. When selling, you just have to input the amount of shares you would like to sell. The second order type is a limit order, which means you're able to specify a price to buy or sell. It ensures price control, but not execution certainty, as the order will only be executed at the specified price or better. A limit order is a bit more complicated. You can choose either the amount of shares you would like to buy or the amount of money you would like to invest. Then you input the price that you would like to execute the order at. Selling with limit orders is much the same as buying. The third order type is a stop order, which is an order used to limit losses or protect gains by triggering a market order when the price reaches a specified level. It's used to sell a security to limit losses or buy a security to protect gains. Stop orders are not as complex as limit orders. When buying, you choose an amount of money you would like to invest, then the price at which you would like to buy the stock. When selling, which is the most common use of stop orders, you put the amount of shares you would like to sell at the specified price. And that's pretty much the basics of buying an asset with stake. Stake and CommSec Pocket both allow you to check on your investments using either their websites or apps, although Stake offers much more information on your investments. Now, while none of this video is financial advice, I can offer a couple tips on how to invest well. First, staying patient is key. Even if your investment loses value the day after you buy it, just hold on to it. It'll most likely go back up. Second is don't rely on the money from your investments. Think of it as a savings account. Don't be too attached. One of the best things you can do to grow a great investment portfolio is to continue learning. This will help you make great decisions on future investments. Now, hopefully after hearing all this, it boosts your confidence a little bit, and I hope you do go and invest your first $100. But I would like to say, remember to stay patient and continue to diversify your portfolio. Also, make sure you do your own research on the current market and any assets you wish to invest in. Thanks for watching.